While everyone's celebrating the flashy headlines from the Trump-Xi summit in Beijing, something much bigger and more dangerous just slipped through the cracks. The $17 billion agriculture deal and those Boeing orders everyone's buzzing about, they might be the distraction. The real story is buried in a quiet Chinese government statement that Wall Street immediately understood. And that's exactly why Boeing shares tanked even after landing one of their biggest contracts in years. 2 days ago, Trump landed in Beijing with a heavyweight crew: Elon Musk, Jensen Huang, Tim Cook. The kind of lineup meant to scream cooperation. The White House rolled out the wins: China committing to hundreds of Boeing planes, massive farm purchases through 2028, GE jet engines flowing again. For a moment, the S&P 500 even punched a new record. It looked like a clear victory lap. But if you actually read between the lines, this summit didn't reset relations. It quietly exposed how much leverage the US just handed over. On the surface, the Boeing deal sounds enormous. 200 aircraft right away, with talk of scaling up to 750 if things go smoothly. Analysts peg the initial order around $17 to $19 billion. Hit the full number, and you're talking 60 to 80 billion. That should be rocket fuel for Boeing's backlog. Except the stock dropped over 3.8% the very next day. Why? Because smart money realized Beijing had been pushing for far more, closer to 500 narrow-body jets plus wide bodies. What Trump announced was the minimum. The bigger slice remains conditional, dangling as future leverage. And everyone knows what China will likely demand to unlock the rest: deeper tariff cuts and tech concessions. Then there's the agriculture piece. China says it will buy $17 billion a year in U.S. farm goods through 2028. Sounds solid for Midwest farmers, right? But zoom out. That number barely tops what America actually shipped to China in 2024, before the latest tariff spikes. It's not explosive new demand. It's mostly returning to old levels. And history shows these promises can evaporate fast. During Trump's first term, China pledged around $28 billion in farm buys and fell short within 2 years. They simply sourced elsewhere when tariffs made American products too expensive. So for this new deal to actually stick, those same tariffs Trump once called permanent pressure tools now have to come down. That's the part barely anyone is highlighting. Right after the summit, China's Commerce Ministry quietly announced they're pushing to negotiate reductions on $30 billion worth of goods, specifically the tariffs the US put in place. Not Chinese tariffs, American ones. The very ones used as leverage for months. Less than 7 months after the last temporary truce, those tools are suddenly on the table. China gave almost nothing on their side in return. That imbalance is what the market priced in instantly. Optimism on Thursday turned into selling pressure by Friday, especially across Asian markets. But the real tension runs deeper than dollars and planes. Trump reportedly wanted China to lean on Iran and help cool the Middle East conflict that's driving up oil prices and squeezing global economies. Beijing said no, flat out. As one of Iran's biggest trading partners, China could have applied serious pressure. Instead, they refused to align with US interests on this. That single refusal tells you everything about how they see this relationship. They'll do business on Boeing jets and soybeans, but they won't trade away their strategic cards in the Middle East just to help stabilize American energy costs. This isn't minor diplomatic friction. It shows China views the tariff truce as purely transactional, not the start of broader alignment. They proved they have clear breaking points. And that puts Trump in a tougher spot heading into the next round of talks. With no election pressure on their side, China can afford to play the long game. Trump needs visible wins sooner. Layer on the rare earth situation, and things get genuinely risky. China still dominates around 70% of mining, 90% of processing, and over 90% of the high-end magnets and oxides that go into everything from EV batteries and AI chips to advanced weapons. During the summit, the US pushed for better access and diversification. What they got was vague language about addressing the issue. That's diplomat speak for kicking the can. No firm commitments, no timeline. The market saw through it immediately. Defense and EV stocks barely moved. Remember what happened back in 2010 when China restricted rare earth exports, even briefly? Prices exploded by up to 1,000%. One mineral jumping from $10 to $100 per kilogram overnight. If Beijing decides to use that leverage again during the next negotiation round, say in exchange for tariff relief, American manufacturers could face sudden shortages. That risk alone keeps investors nervous. Here's what makes this especially tricky. The framework agreed on calls for both sides to work toward cutting tariffs on over $30 billion of goods each. Sounds balanced on paper. But the reality is asymmetrical. Trump can reduce U.S. tariffs relatively quickly without Congress. China's process is slower and tangled in wider international relationships. That gives China an edge in dragging things out while still extracting more. History adds another warning layer. The 2025 South Korea truce followed a similar pattern. Big promises that started cracking within months. We've seen this cycle before. So what does all this actually mean for your money? Markets are currently pricing in three broad paths. The optimistic one, around 40% implied probability, is that tariff cuts actually happen. Inflation cools modestly, and the Fed stays measured. That would favor cyclicals like industrials, materials, and energy, while giving Boeing and exporters real tailwinds. The middle muddle-through scenario, which many traders seem to lean toward, means drawn-out talks, smaller concessions, and persistent uncertainty into late 2026. Sticky inflation, compressed margins, rotation into defensives. Then there's the lower probability but dangerous path where Trump cuts U.S. tariffs first to juice short-term numbers, only for China to hold back and demand more on rare earths or other strategic issues. That could widen the trade deficit, strengthen the dollar further, and create ripple effects in emerging markets. The upcoming Xi visit to Washington in September looms as the real test. If they lock in the full 750-plane framework with enforcement teeth and specific tariff timelines, we could see a solid relief rally. But if it's more vague language and postponed decisions, expect volatility and possible 5 to 8% pullbacks in broader equities. The Beijing summit delivered some real orders and photo ops, but it also revealed cracks. The U.S. put its tariff leverage on the table early. China kept its strategic cards close, especially on Iran and rare earths. That imbalance is why Boeing fell despite the headlines, why certain sectors sold off, and why seasoned investors aren't fully buying the victory narrative. Bottom line, this wasn't the reset many hoped for. It was an opening move in a longer, higher-stakes game. The real negotiation still lies ahead. September will show whether this was genuine progress or just another round of strategic theater. Until then, staying selective and watching the fine print matters more than ever. What do you think? Will China deliver on the bigger aircraft orders or use them as bargaining chips again? Drop your take below and make sure you're subscribed so you don't miss how this unfolds next.